Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Thursday. Well, let's get into what's going on at a macro level. And the US Federal Reserve has agreed to hold interest rates steady at the June meeting as a way to buy time and assess whether further rate hikes would be needed, even as the vast majority of voting members expected they would eventually need to tighten policy further. That's according to FOMC minutes from the June meeting, which revealed most judged it appropriate to maintain the Fed funds rate at between 5 and 5.25%. Saying most of those participants observed that leaving the target range unchanged at this meeting would allow them more time to assess the economy's progress. Expectations for a 25 basis point hike from the Fed at its July meeting have risen to 88%. Now, Treasury yields firmed with the 10-year up to 3.93% and the 2-year at 4.94%, and the US dollar edged higher against most major currencies on the prospect of high interest rates. The Aussie dollar, it's fallen in line with the Chinese yuan after data showed China's services activity expanded at the slowest pace for 5 months in June. The Aussie trading at 66.9. And in the latest US economic data, new orders for goods increased less than expected in May, with a lift in aircraft orders offset by softness elsewhere as high interest rates erode demand. Factory orders rising 0.3% after advancing by the same margin in April. Meanwhile, on the trade front, China's export controls on metals used in semiconductors are just a start. That's according to former Vice Commerce Minister Wei Jianguo, with Beijing's move coming ahead of a visit from US Treasury Secretary Janet Yellen. Wei added that if restrictions targeting China's high-tech sector continue, then countermeasures will escalate. All right, so lots to watch, and also with US non-farm payrolls out at the end of this week at the same time. To get across it all and some investment tips, John Blank joining us from Zacks Investment Research. John, very good to catch up with you. Thanks for joining us again. Let's start with those Fed minutes. Any particular takeouts from you? Was that instructive at all, or is it pretty much as we anticipated that we're heading towards, or you're heading towards another hike at the end of the month?
Andrew, I think a 7 basis point move on the 10-year to 3.94 was significant, and it's telling you that the unanimity of the FOMC minutes convinced people that the dot plot is really serious. There's a lot less dispersion than people think, and so they're taking out the tails on this matter basically from the minutes. And so basically, we're heading higher. I think 4.27 on the 10-year is where I've been targeting heading. That was the high we saw back a ways ago. So we've got another 30 basis points from here, and I think we're just going to rally, through the summer to get up there.
All right, John. Now, of course, the other big issue, which I just covered there, is what's going on in trade developments between the US and China. In particular, those metals used in semiconductors. How concerned are you about where this is going?
Well, Andrew, it's a lot of game playing right now. We've got, the United States announcing restrictions on, the AI chips and now the cloud computing, and they're just, and the Chinese are, as they spoke to, countermeasures that, the rare earths. So what they're trying to do here is propose, I'm stronger than you kind of thing as Yellen shows up in the country. They don't seem to be coming to the United States here. So it does seem to like, hey, they want, our senior officials to show up in China and sort of, make a deal. So I would think, the positive way to look at it, and there's probably, a lot of ways to look at it, but let's try the positive way, which is they're going to sit down and start talking again. And that this is the opening round where you position yourself tough. So from a negotiating perspective, I think, we should hope that in the next 6 months, these two parties sit down and do a much more serious discussion of what happened after the Trump trade deal and whether we can move forward on this. That would be the positive way to look at it.
Well, so you're not necessarily convinced that the Chinese are going to follow through, that this is more sort of the optics, given the arrival of Janet Yellen?
That's absolutely what I think. I think this is all for the domestic audience. They want to make it look tough. And that's what you do for your domestic audience. So yeah, I would step back and just realize the optics are probably what's in play here until Yellen gets there, and hopefully they'll find some way to talk to each other in a more civil way. And hopefully she stays the 4 days. I mean, I'd like to hope that she stays long enough that's successful there.
All right, John, well, let's get into what you're seeing investment-wise. You always come to us with three stocks. Let's get into them then. The first one being Royal Caribbean Cruises. Look, as we well know, we're back on in terms of cruising, given what we went through with COVID. To what point, though? What are you seeing with this stock?
Yeah, look, this is fascinating. Take a look at this chart. The main thing I want to draw everybody's eyeballs to is those earnings estimates up at the 110, 120 area. That the brown line's now, by the way, 2025. So our system's starting to pick up the 2025 earnings, which is significant. So that's telling you that fair value looks on these stocks are starting to go all the way out to 25. And so the target price is 109 here. That's basically the middle of that pre-COVID range. So the stock's going to get back up there. Incredible 2.5 beta stock. I mean, you could have bought it at $50 a share at January 1st this year, and it's up at almost 103 now. So incredible run, great momentum trade to 110. Still a little more, $10 more to it. The thing I found interesting, Andrew, is the net profit margin of these guys is -9% because of the debt they piled up. Kind of incredible to realize, if you just look at this chart, they had those 8 COVID quarters, 6 of 8 were red, they got hammered. And now they've got 5 post-COVID quarters of really strong, surprises. So just kind of interesting from a perspective of where we are in the leisure, growth cycle. Still a little bit more to go, and COVID is basically coming to an end. Andrew, at the top of the level, the VIX is at 14, and the last time the VIX has been this low is pre-COVID. So the market at a broad level and a stock like this are kind of telling you we still got, a couple more months, 3 more months to get back to a post-COVID, trading environment.
All right. Okay. So that's Royal Caribbean. John, let's move on to China Holdings, which is actually US based, but it's it's a restaurant, fast food operation, just has a number of global brands there.
Yeah, Andrew, this is great for the discussion we've already had about China. So again, 2025 numbers up at 70, 2024 numbers you can get to 65. So interesting stock, and then the sense that it's been doing quite well. You can see from the momentum. So people are shopping and eating in China after the COVID experience there, which is remarkable to keep in mind here. That people are really done with it in China as far as they're concerned. I'd be a little worried here just because their vaccines are so poor. You have to wonder if long COVID and just the caseload there that they're hiding from us is part of the bear case on a stock like this. But at the end of the day, it looks sharp from a momentum perspective. Nice entry point. I would tell you also 3/4 of this is the franchise for Kentucky Fried Chicken. This is basically Kentucky Fried Chicken and Pizza Hut, which is the other quarter. So at the end of the day, it's a franchisor of Kentucky Fried Chicken.
Right. Okay. And clearly that's pretty popular in China. But as you say, some concerns there, particularly the efficacy of those vaccines and the prospect perhaps that you may see some more lockdowns.
That's it, Andrew. I think, the basic bear case that nobody wants to talk about because it's not politic to do it is their low growth is because they really blew the COVID, right? They had poor vaccines. They didn't turn to the United States for Pfizer and Moderna. They stayed the course trying to appeal that they had this technology. And of course, from the Wuhan experience through their vaccinations, we're learning that the healthcare system, the infection system in that country is not up to standard. So part of the slow growth is that story that they're just not really together on the COVID.
All right, to number 3, Verisign Software and Services. What does this do?
Verisign, this is your domain registry supplier. So this is .com, .gov, .net. This is in Virginia. It's somewhat related, to a deal they have with the General Services Administration in the United States. basically registering names for 1 to 10 years when you want to get on the internet. Incredible net profit margin, almost 50% on what they make on a profit margin. Not a great sales growth, about 5% a year. But if you look at this again from the 2025 perspective, you can get a price target up in the 260s, 250s, and get another 15, 20% a year. So from this perspective, what you can learn from all these stocks, they're all in strong industries with A's for growth, with certain improvement in their estimate revisions the last month or two, is that there's still a cycle here, and we still got a ways to go. If you look at bottoms up price targets, Andrew, they're 8% higher from here, and they're topping out at basically where we were before this whole thing rolled over. So we got a little more to go, I think, just because the bulls control the floor right now. These are the stocks that are showing you why. All
right. And John, on a broader level then, given we now entered the second half of the year, taking a look back at that outperformance we saw, particularly among tech stocks, of course, in the first half, is that sustainable in your book?
Well, we'll see. I mean, tech stocks, we're going to have to find out if they broaden out, inside the tech land and then outside of tech itself. So there's kind of two levels of broadening here. One, if we get out of these big tech stocks into more tech stocks. And then the other one is we get into other sectors. And at this point in time, from our systems, I see strong consumer staples, strong consumer discretionary, strong industrials because of the infrastructure package, and strong tech. And then basically it's kind of a mixed bag outside of that. So can 4 of 10 sectors keep this economy up here going? Certainly, at a 2% growth rate, yes, but I don't know if it can do more than that without more participation. So it's just kind of a wait and see here this summer, Andrew.
John, always a good value to catch up with your thoughts from Zacks Investment Research. Thanks so much for joining us.
Yeah, thanks, Andrew.
All right, that is the global view for this Thursday, just before we go. So a check of the local market when we get underway in just a couple of minutes' time. We are expecting to open lower, as you can see, SPI futures off 0.5%. Stay with us. The open is just around the corner.